Good. Second.
Okay, good afternoon. Thank you very much. Again, I'm going to give our Bernstein, looking down on the world perspective on enhanced oil recovery, what we see the trends are, what we see the big and small companies pursuing today and over the last couple of years, and what that might mean going forward, together with some insights from an economical perspective on the different types of enhanced oil recovery. It's quite interesting, at least in contrast. I've just come back from Brazil, where we're looking at some of the Brazilian oil companies where EOR is definitely not needed because you have significant flow rates of 20 to 50,000 barrels per day in some beautifully preserved reservoirs. So, in contrast, there's some very exciting resources where this technology is not going to be applicable for some time. But let's take a look at what's happening in this particular area. I mean, all of these points you're all very familiar with. Easy oil and gas, we've heard this before this morning. Significant resources still available to come out. So the prize is material, and it's very exciting from our perspective, given our views on the oil price and given where the oil price is today. A lot of these things become a lot more economical. So there are many estimates out there. You've heard some of them, but it's no different than China moving 1% on its oil or gas fuel mix can lead to a big expansion in demand. Same thing here, a 1 or 2 or 5% increase in recovery factors leads to multi-billion barrels of resource potential. So that's the prize, that's what's on offer. What's being done? Well, if you look globally today, you will see that CO2 is a preferred mechanism. We've heard that discussed this morning. Steam being second here in the second column, with roughly equivalent numbers of up to 150 key projects in operation today. These two really leading the pack relative to chemicals and in situ combustion or even some of the microbe type technologies being offered today. So the focus is definitely here, and maybe that the industry will catch up as per the last talk to some of these over time. But we're definitely stuck in these two categories today, and so that's primarily the focus. Is it actually working? Does it make sense? Does it make sense relative to some other resource plays which are opening up? And I think that'll probably where at the end I'll be leaving it is with another resource play which is opening up aggressively and actually offers probably more attractive economics. So also interesting to look at the entire EOR project list over time. You get the sense here that we had a very big ramp up of all types of technology, thermal, chemical and gases, up to the early 1990s, and a bit of certainly a tail off over the last 20 years, with the exception of gases, which again is the CO2, which is still continuing to show some growth here. But chemicals losing out in terms of favor here, definitely relative to CO2 and nitrogen before that. Again, if you split it down by geography, just again interesting to see where it's all happening. It's definitely all happening in the US and Canada. That's primarily, again, the CO2, as you can see here in the green, and also in Canada, CO2. So that's driving the big project list we saw in the prior slide. Equally in Venezuela, it's Lake Maracaibo, etc., heavy oil, all of it requiring heavy steam injection in order to get that heavy crude to start moving. So that's really that part of the world is certainly much more aggressive in this technology. But interestingly, you find that when you break it down by formation type, a clear focus here on the sandstones reservoirs. You just don't see the same activity levels coming through the carbonates, and I'm sure everyone here knows, can explain that as strongly. Primarily, a lot of the enhanced fluids that are being used are migrating through this, the fracture networks in these carbonates, and you're just not getting the sweep efficiency which was discussed before. So you can see here sandstones being the preferred resource. So that's what the companies will be seeking in order to trial and test out this particular enhanced oil recovery. So other interesting things, the steam is important in Venezuela. SAGD, as you know, as an enhanced oil recovery technique, is also widely utilized in the oil sands. What you find here is that there are some interesting analyses you can do, and you do find that it does tend to be the shallower reservoirs and the higher permeability. Here, permeability on the y-axis and reservoir depth on the x-axis, but it's really these bottom 6 or 7 formations, which are all in the Fort McMurray region of Athabasca, are the ones where this is commercially proven and working. Yeah, some of the other formations in Canada, not yet working as well as Fort McMurray region. And then if you look at some of the heavier oils, et cetera, you could, well, we haven't seen the same level of commercially active projects coming through over time. You know, we know that when countries like Venezuela increase the tax environment strongly, you tend to see a lot of the companies exiting. We saw that 5 years ago, a divergence in the group company strategies. Certain big integrated oils just left the country altogether, not prepared to take those reduced levels of returns relative to the targets they set internally. So some companies preferred to stay, given that it's such a large resource, and that's how the company's strategies actually change over time. So that's quite interesting. No different than, you know, going into Iraq today for very, very low margin per barrel. So in you know, the US has been the success case. It still is. There's, you know, about 10 to 12% of their total production, 5.5 million barrels per day, is coming from really the thermal and the gas EOR led production, with, you know, the CO2 increasingly taking a bit more share of that production over the last 10 years relative to the 10 years before that. So the problem here is obviously gas and getting as much CO2 as necessary. And I think, you know, looking at some of the, there are companies who are adopting this very successfully. So there are smaller companies doing this, and it's getting access to CO2, which is crucial in order to continue this. So these are some of the key plays. You will know the Permian Basin, but you can see over this 20-year period how quickly that production's come up purely from CO2 injection. So it does work, and you're starting to get to incremental, you know, material numbers here. 250,000 barrels per day of production is definitely material. The problem is is actually, you know, CO2, and this is one of the logistical hurdles to ramping this up materially over time, and it's having access to the CO2. And I know there are people here that are focusing now on the industrial side in order to source CO2, but largely the US did have a plethora, say, of CO2 pipelines which were able to transport that into the key basins in order to enhance that production. So successful downstream, upstream combination, getting past that big logistical hurdle. So we touched, Norway was mentioned before. Norway is a very successful case here. I mean, reserve recovery ratios are some of the highest globally, and that's despite a very harsh tax regime of up to 78% tax. You know, but it's the stability of that that obviously allows companies to make these investment decisions. But, you know, I'm sure people are aware of some of these big fields, whether it's Statfjord or Ekofisk, you know, all types of enhanced oil recovery programs being rolled out, and ultimately changing the direction of large fields very significantly for a long period of time. So there are some very, you know, the prize is attractive, and the success cases do exist across this industry, primarily Norway from our perspective. But I think what's interesting is, you know, how widely adopted is this by the global integrated oil companies. When you plot, this is, you know, improved oil recovery EOR additions as a separate category of disclosure by large oil companies. And when you plot that over the long term, and especially plotting it with the oil price, it's not been as widely adopted as you might have expected, especially with the 5 times increase in the oil price. And we're not, you know, back here it was about 1 billion barrels being added per year by the largest oil companies. Today we've seen that diminish quite markedly, and that's, you know, we're not at $20 oil anymore. We're 5 times that. So, you know, certainly the bigger group of companies, and that's why I say some smaller companies are doing this very, very successfully. The big integrateds definitely not adopting this as a preferred strategy. I will mention BP because BP is actually, within that group of companies, has the opposite trend. If you just break out all the companies, most of them following this declining booking of enhanced oil recovery reserves over the last 10 years, BP has been very vocal about this is an easy prize to go for, and they've publicly always put out this 1% improvement in their original reserve base can offer them an extra 2 billion barrels of reserves. So whether it's a more desalinated fluid that they're trying to use, definitely seemingly working here from the reported data. So they're definitely adopting this much more so than the rest of the Western integrated oil companies. So it is an easy prize, and BP certainly being successful. And so in terms, somebody was asking about economics before. I mean, in the US being the success case, you have the CO2. How does it all work out? Well, a lot of the companies still are using $70. Well, they are using $70 oil prices for planning purposes today. Very different than 5-10 years ago when it was 20. So they're willing to accept this higher oil price to sanction projects. We always have, and this is a shell field. By the way, showing you the sort of stabilization and improvement in oil production here as the CO2 came in. So, but in terms of numbers, if you use a $70 oil price, we always have a realization difference on the actual oil that comes out. It never generates exactly the WTI price that you see. You then have obviously a capital cost required per well that you're drilling, and then you have your CO2 cost, which can be up to this sort of magnitude of $15. Then we have our OPEX, ultimately ending up with a pre-tax margin per barrel of $15 to $25. And then you would have to take off 35% of that for corporate tax. So you can see whether that's $10, $15 per barrel, net income per barrel. It's a healthy margin. It's ultimately Statoil would actually make that type of margin based on that very high tax rate in Norway. Some of the other companies would make 15 to 20. So again, you're going to have decision making going on there, whether this is actually attractive. But I think that's mostly CO2 led. Access to CO2 is the critical question here. Chemicals is being discussed a lot more, not widely adopted as we saw from the very first chart. Cairns is a good example here. They are adopting it in India, and if it works, you're going to have this uplift of production at their MBA field in Rajasthan of this level of magnitude. So you can see it can be really meaningful. They're testing that at the moment over a 12-month period. The interesting thing about this field is, there's multi-layers and cores. This is a poro-perm chart, but you can see really where it's a very high quality resource, right? It's a very high quality reservoir, very 30% porosity and significantly high permeability. So if anything's going to work in here, this is the reservoir to at least trial it on. The red stars here are, I plotted these on here where, you'll know the Daijing field in China. Again, healthy porosity and permeability, and chemical polymer flooding actually works very successful. So that's here. You may expect some of these fields, certainly in the portfolio of Cairn, to perhaps show you a success case. We will know later on this year. But getting back to economics, the question, the key point about why this company is doing this is they have a very healthy tax break on this field. They have 7 years of no income tax payable within the PSC of this production. Chemicals costs, you may have $9 OPEX. Chemicals will add another $5-6 per barrel to source the sodium bicarbonate or whatever type of polymer they intend to use. They haven't quite worked out how to get it up to Rajasthan, but you're going to be adding a $5-6 OPEX increment for the chemical costs. But because you're not paying a big whack in corporate tax, it makes it worthwhile, especially if you have a highly productive reservoir. So that's again how you see these projects being sanctioned and move forward if you have a very favorable set of fiscal terms associated with the field. But I said I wanted to touch on the sort of what I see as a competing resource base, which is coming up today, you will be aware of unconventional gas in North America. Now, all the push and the capital and the drilling is shifting into oil shale. It started off here in the Bakken shale, and you can see here, it's the very same process, taking the horizontal drilling, the fracking, applying it to the actual source rocks, and this actually is more of a carbonate type source rock, but it's working very, very successfully, as you can see from the production growth here, just illustratively. And if you spend last week as well, I was in Houston, and you spend a day there, you're going to get some very big projections for oil production capacity coming from the oil shale plays across North America. So, there's, I don't know how much is there, but 300,000 barrels per day. There are numbers 3-4 times that being postulated for production coming out of this resource base over the next 5 years. So, and I think then when you start to look at the economics of this, you will see this competing with a lot of enhanced oil recovery projects, because what's happening here is you use your fracking technology or your horizontal drilling. That might be a bit difficult to read, but ultimately these wells are costing you $20 million. You have OPEX of 5 or 6. You may have the discount to WTI here, which is $7 or $8 per barrel, that differential on the quality of the oil. Ultimately, we had that 15 to 25 pre-tax margin before. Here, I've just summed up what would be the illustrative pre-tax margin for some of these oil shales in North America. So you can see $52, $36, $39 per barrel before that 30% tax rate. So these work. That's why, this technology that's being created in North America, the gas is not working as well, because ultimately they've depressed the gas price, and that's why you're seeing this, taking the technology, trying it on the oil shale. It's working. The margins show you why it's working, and as you have a global fungible oil price with demand led by Asia, you can see more and more of this going to happen. So it's expecting 1 million barrels per day, coming from this resource base in the next 5 years. Probably is not a bad estimate at this point. So I've been quite rapid today, but that was the key points I wanted to make. There are challenges, there are regulation issues in other countries. Maybe that's why the majors are not pursuing it as aggressively. You need the government interest, and it's one of the things you see in many countries, especially in terms of subsidies. And obviously the availability of CO2 is crucial. It's becoming more so in the US to continue the CO2-led production there. But more and more people are looking at it. It's being discussed more and more, whether it's Statoil or others. But this is a risk as we see it. It's just the sudden appearance of other unconventional resources, and the problem is, everybody's over there learning this technology, and then they will be going globally to identify further unconventional oil shales where they could also try out this technology. So, it's from our perspective, it's definitely something that will move in terms of enhanced oil recovery. The bigger companies not aggressively pursuing it. This looks much more attractive to them. So I'm going to leave it there, and I'm going to take your questions.
Okay, any question? Please, yeah.
Thank you, very interesting. Would you not suggest, I would suggest that perhaps there was some portfolio management in it from the larger companies divesting their more mature fields, hence the smaller players coming in with the EOR being a play within this. What do you think about that?
Yeah, there's the normal run rate of divestitures in the majors' portfolios. If you look, even Shell yesterday talking about $3 billion a year of assets will be disposed of every single year. That's their long-term run rate. Today it's a little bit higher because there's good prices available, but the increase, there hasn't been a market increase in divestitures by these companies relative to the prior decade and the last decade.
No, I was just looking at the Permian Basin there and look at the divesting in there over the last 20 years to the small plays, and that seems to be a massive uptake of EOR in the US, where there's been an exit of the majors. So
and there's for sure. So it's, Denbury and all these Whiting, all these companies that are pursuing this, and that's why I mentioned there are small companies doing this very successfully. That's where it's working and being focused. I'm just trying to highlight that it's not aggressively pursued by the bigger guys.
Yeah, portfolio management may be part of that.
Yeah.
Okay. Please, go back.
Hello, I'm Bob Akmaladi from the Centre for Global Strategic Analysis. I wonder if you could tell us, are you aware, either having carried out the research yourself or by anyone else, regarding the energy return on energy invested analysis with enhanced oil recovery?
Yeah, you asked that before, yeah. I know it's actually an increasing question. I've had the question quite recently. So there are people looking at it. I don't have the answer yet, unfortunately, sorry.
I have two simple questions. One is, I wonder if you have an estimate for the cost of the increased barrel for a large reservoir, talking about giant reservoir, billions of reserves. And the other one is that I wonder if you could convert your dollars per barrel investment or total cost into internal rate of return. And you made the remark about Iraq margin is very low. I hear even BP, who in defense of reducing their remuneration from $4 per barrel to $2 per barrel, declared that they would be making 20% internal rate of return. Do you still call that low?
Well, I call it low because this industry, from our experience, is not very good with deliverability on projects. So there's a very high sensitivity to 1 year delay, 2 year delays. You can drop your MPV and your IR by 50% with a 2 year delay.
In Iraq, for your information, I'm sure you know that, BP will get total return of their costs within a year or two from starting their investment. The total cost in Iraq, combined exploration, combined operating cost and capital investment, is in the region of $3 total. Now, when you get a remuneration of 2, and of course their net is about $1, that's over 20%. You still call that too low. So it would help to convert your dollars per barrel into return on investment to compare. I would appreciate
Yeah,
that.
I mean, the question. I mean, you bring in a lot of volumes at $2 per barrel,
Of course,
and BP will make
exactly.
10 times that in the rest of the portfolio.
Right.
So from a market perspective, you're actually bringing in a lot of diluted barrels.
So,
Well, that impacts the market valuation of a company.
of course.
So yes, over the long term you
But
may
that
make.
then makes BP making a very good return on their investment, and like what you said.
I think Ozzy's point is, to you and I, it seems like a good return. Compared with the other places BP could spend its money, it's not a good return. So BP could go into deep water in, let's say, somewhere in West Africa, and get $20 to $25 a barrel. Clearly, you can go into the shale oils in northeastern US and get 40.
Yes.
So, and every company has a limited stack of dollar bills and decides, and a set of projects that are like this, and they just Let's do the top 20
Agreed,
mountains.
but volume matters, particularly when we talk about peak oil and how soon you will have it, and when a company like BP, who has 6 million barrels per day refining capacity, they are certainly interested in the long-term supply when they work on a reservoir that will be producing 2-3 million barrels per day.
Absolutely.
And so the combination, I'm baffled to hear it is too low when you combine all factors related. I still would appreciate to have the cost per barrel increase, the cost per EOR.
In terms of returns.
Yes. Well, just simple cost, what would it be? How many dollars per barrel recovered?
The marginal value. What does it cost you?
You're introducing EOR to a reservoir, and you're getting additional barrels. What is the cost per barrel, additional barrel recovered?
Well, to us, we've already done this analysis, and we need, $75, $80 oil prices. It's the marginal cost of oil supply today. And that's not for enhanced oil recovery-led projects. There are other projects that are setting that price.
Question. I'm asking
Maybe we'll take it after.
the capital cost per barrel, additional barrel you recover. $3, $5, $10.
What he's saying is there's a heck of a lot of projects in the world now that
Yeah.
are not making money at $70 or $80.
Yeah, but these are the
No, no.
test sites.
Yeah.
I'm talking
Why
just
don't you
cost.
pursue it later, because I think, Anybody else got any questions before we, one more and then we stop. Not that you've monopolised the microphone. I've asked the same question 4 or 5 times.
Yes. It might be number 6.
I mentioned something like that.
Yes. Well, since no one else wants to ask, you said you had models that showed when an oil field becomes economic, it's, for example, $75 a barrel. Is it possible is it proprietary, or is it can we get hold of the assumptions that went into the model, for example, steel prices, etc., equipment prices? Because obviously they can all move, so...
Yeah, and absolutely, this was the price in 2006-07. We haven't increased it. We have had 20% deflation in a lot of the costs you're talking about, but they're actually all back up again, 10% in the last 12 months. So even though our number hasn't moved in the last few years, it's still a good assessment because prices are actually on the increase again. It's a simple case of you take the marginal source of supply and you work out the total, the 90th percentile on your entire cost base. That's how we construct that number, by the way.
And another answer is, if there's anybody from IHS here, I think there was earlier at least. I mean, IHS do publish all that sort of stuff all the time, every year. You just have to pay a fee and you will get what you need. Okay, one more question and then we'll stop.
You emphasized a lot about the CO2 playing a major role in the recovery. How do you see the shaping of collection of the CO2? Are you thinking of cluster industries generating CO2 and you capture it, pump it or whatever, or compress it? What are your thoughts? And what impact will that have on the cost? Because currently, obviously, with few suppliers, the cost may be high, but with going into the future, hopefully the cost comes lower and it contributes to a greater number of barrels coming home.
Absolutely, I totally agree. It has to be the clustering of industrial sites, pulling it all together collectively through one exit path and taking that to the required reservoirs. That's the key source.
But the clustering is mainly in developed countries, and the resource is mainly in underdeveloped countries. So where is the? How do you see it?
One thing is certainly the sandstone reservoirs and the carbonate reservoirs, and you're also If you're talking about the Middle East, you have a dominance of the latter, which also draws some complexities into that statement. But there's still a lot of untouched North Sea, got U.S. onshore. I mean, it still works there, and that's together. Now, I'm not talking about shipping CO2 to other parts of the world. Not something we see happening. Yeah.
Why not in the future? I mean, like LNG. Huh?
Yeah.
Send the boat back with CO2 in it. Yeah. Okay, let's. Thank you, Oz.
Welcome.
I would say actually.